So good time of the day, everybody. We have our expert of the day or the year today, Lisa Niser. She is an accountant, and I know she looks very young, but she's been in business for over a couple decades now. So it's a great resource, and we're gonna have an opportunity to speak with her and get some of your questions answered. Lisa, would you like to say a few more words about your experience?
Sure. Thank you so much. It's always fun to talk about taxes. I can make them fun. Like Svetlana said, I have been in business. Well, I've been doing taxes for 25 years. I've been on my own for 18. So I work with just individuals and small business owners. I work with a lot of realtors, a lot of real estate investors, a lot of young families. And I really just love the education side of it because I don't think we're taught about taxes very much, and money we interact with every day. So I'm really excited that you asked me to come so we can teach people important things they need to know.
Awesome. Well, thank you for coming. And actually, the other thing I like about Lisa is it's always fun. Taxes are boring for most people, and they don't want to hear nothing. And if anything, we are opening up our series with an accountant. And actually, I have a list of your questions that many of you ask me when you're buying or selling your home. So we're going to get them addressed by a professional so that you have references and somewhere to go if you have further questions. So we'll start with the selling your house process. A lot of people come to me and say, well, I'm selling my house. I'm probably going to make that much, a lot of money. What are my tax implications?
That is a great question. And for many people these days, there is no taxable gain, which is really nice. It's one of the few really good tax benefits. So if it is your principal residence and you lived in it for at least 2 out of the 5 years prior to sale, you can exclude up to $250,000 of gain if you're single and $500,000 of gain if you're married. So for the bulk of the people out there, there's nothing. So if that is the case and you are not issued what's called a Form 1099-S, you don't even have to report it on your tax return, which is super nice. Now, on the flip side, if you sell it at a loss, it's just a personal loss and you don't get any deduction. People call me all the time, like just, because there's both sides of it, which is really nice if you happen to buy a house that's, appreciated. Now, there are people that do have taxable gains. I mean, my mother bought her house for $47,000 however many years ago. She has a taxable gain, but for the most of it, you're only paying the tax on what's ever above that. So that's really nice for most people. Especially now, if you get that 1099, or if you have a taxable gain, or if you had a home office, you do have to report that. So in that case, you need to make sure that you have the closing statement, that HUD-1, the form with all those lines on it, that you will need, because you take the sales price less all the closing costs, so that you net less, and then you compare it to what you paid for it plus the closing costs plus any capital improvements you make. It's not little repairs, but if you added on a room or you added appliances or all that gets there. So it's really important when you are a homeowner that, one, you keep all those closing statements. You don't need the whole packet. I mean, I've never seen, it's crazy in real estate how many
34 pages.
But just that HUD-1, you need to make sure you keep, and then any capital improvements, you want to just keep a folder with all those on there. Plus, it's just good for your own knowledge to know where, even if it's not taxable, did you make money? Did you lose money? Where is it at? Just for your own information. But that's how you do it. Now, if you had a home office, that part of your house is not considered principal residence. So that percentage has to get carved out, and that is going to be taxed if there's a taxable gain because it's not a principal residence. So that one, there's a separate form that you calculate it on, and the same way. And then if there is a gain, it's taxable at 25% on the federal side, up to the amount of depreciation that was taken on that property, which is a whole different ballgame, and I won't get into it right now. But and then the rest is taxed at long-term capital gains rate. So it's still not bad, but just keep in mind that if you have reported that home office on your tax return, they're going to be looking for that. So I still think it's worth it to take the home office if you actually have it, but just don't forget that part of it.
Yep. And what I'm hearing from this information is when you're buying your primary residence, you should keep track of all your improvements from the day one, because that's gonna play at the end when you decide to sell it.
Yes, yes. So people are like, oh, I did this. Do I get anything? I'm like, no, just keep it. Now, one other thing upon sales is in Illinois, we pay real estate taxes a year in arrears. So, you know, in 2021, we're paying our 2020 liability. So when you sell a property, you have to pay at closing for the time up until the date you sold it. So you're going to pay additional amounts on that closing statement. So while that's not included in the calculation for the gain or loss, and a lot of people don't get the benefit for that on their itemized deductions, Illinois does give you a property tax credit. So you want to make sure that you add that amount in so you get the full amount of your property tax credit on Illinois, because a lot of people miss that. On the flip side, when you buy it, you get a credit for the taxes that you're going to have to pay out from the prior owner. You have to subtract that.
Yeah.
People do that wrong.
Yeah. It's nice to have professional who can just do it. So
It's done wrong all the time.
So on the flip side, I have some people who are selling their investment property, and they ask me what are my tax implications, because I'm not going to get that 250 or 500,000 deduction. What do they need to know in order to get some kind of idea, and what is
So
the
there's
bracket?
two kinds of investment properties. One is just like a second home, and then there's like a rental property. Are you
I'm talking about the rental?
Rental. Okay. So if you sell a rental, yes, it's going to be a gain or a loss. Now, the good thing is if there is a loss, it's a business property. So you can take that loss against your other income. Now, people are like, oh, it's a loss. It's great. I'm like, you still lost money, right? Like, okay, gains are good. Like, I think sometimes people forget about that. But you do the same thing is you take, the sales price less the closing cost, and then you compare it to your adjusted basis, which is tracked in your tax return on the rental forms and the depreciation forms, because you are able to take a portion of that property's value every year. So there is a pretty, your cost basis goes down a lot by that depreciation. Now people are like, well, that doesn't make sense. But here's the thing to keep in mind. That depreciation expense saves you taxes at your ordinary income rates. And the gain you're paying is at capital gains rates, which are about half, up to half. So it is still good. Do you mean like people like, but I don't want to take it. You have to take depreciation.
But you take appreciation every year.
Every year you get it. And I can talk about that when we go about the benefits of it. But there is still value to that because the gain is at capital gains rates and the depreciation saves you ordinary income rates. So there's a differential in there. Plus, you don't have a choice. People are like, oh, I'm just not going to take it. That's not a choice. You have to take it. So, and if you don't take it, they'll recalculate it as if you took it. So you want to take it. Like it's not an option. So that's the same thing. So you're going to do that. There's a separate tax form that goes through. Now, what's nice is if you have a rental property at certain income levels, you don't get to take any losses currently. They're called suspended because rental real estate is considered passive income. So like earned income, like your wages or your business income, you actively earn it. And even if you work full-time in your rentals, like it's considered a passive activity and you can only take passive losses against passive income. So if you make over 150,000 and you have a loss, it doesn't go away, but you don't get to take it current. And that's really important for people looking at investment properties to understand for cash flow purposes. They're not getting that tax benefit every single year along the way. You know what I mean? So for cash flow, they need to understand that, most people that are buying multiple investment properties probably make over 150,000 to be able to have multiple. So that's going to be suspended. Then in the year that you sell it, all those losses are released and taken against your other stuff. And then the gain is as well. So it's an interesting thing. You may have more losses than the gain. Do you mean? So it's
like accumulation over the time that would play. So it's more like really, I always send people back to their accountant to find that kind of combination out. And I've had couple where they had only one rental. They were not really investors. And they switched some accountants on the way and they're like, I don't really know anymore. Is there a way for them to track it back?
Well, it should be in your tax return every year. So your accountants should have its form 4562, the depreciation form. If you have rental properties, make sure your accountant is including the details for that. So my software prints out all the assets in there, and then, you know, the cost basis and the accumulated depreciation. So I can just pull that from a prior accountant's. It's kind of like when you move investments from one brokerage house to the next, you have to make sure that the cost basis, that's part of your responsibility as a business owner or a rental owner, is to make sure that that gets, you know, entered properly. Now, any good accountant should look back and be like, well, what did you have last year? And go back and ask your old accountant. I mean, that's pretty standard. But that, you know, for rental real estate, it's in there. Now, for personal stuff, one of the reasons why it's really important to keep that closing statement is people don't, well, then you're not getting the benefit of all those closing costs. So people are like, oh, I paid $325 for it. I'm like,
Yeah, but you have,
no, the closing costs are significant,
Yeah.
and it could make a difference. I'm like, no, you need to keep this stuff. Like, just scan it, put in a folder.
just
You know,
scan
it's like, it's not that hard.
Yeah, you don't
But
have.
so many years down the road that, now, if you scan and keep in the cloud, it should be around.
Yeah, I mean, it's worse to do it once, and then professionals can make it happen. And yeah, the closing costs can be like 6, 7, 10, 15,000, depends what
Oh,
you do.
yeah.
Those are adds up. All right.
And so, you know, I take what people, you know, here's the thing, taxes in general, it's an honor system. So unless it's something that's on a form, like, you know, charitables, it's an honor system. So unless they come asking, or business expenses, they're taking you, so you just have to have the backup. So if they don't have that closing statement, then I'm like, okay, what'd you pay for? Okay, I paid $325. Okay, we're using $325. I mean, you do the best you can with it, within reason, but they are missing things that could help them. So it's to your benefit,
Yeah,
to be smart about it. I mean, you don't have to keep every receipt, but there are some that you really do need to keep.
well,
Or
with
like your business expenses. You
yeah,
must keep them.
technologies, it's easy. You just scan it in and keep it somewhere
I
else.
have a file back here, like just stick it in your file.
Yeah, right. Whatever it takes.
Or your scan. I love scanners, man. That's great.
Yeah, I'm with you. Yep, I'm everything computerized, no
Perfect.
paper trail. Yep. All right. Well, Lisa, let's switch to the other end of the game. When actually Chicago is a great market because there are opportunities for people to buy where their monthly payment would be lower than the rent that they pay in today. So it's actually very beneficial for people to own real estate. But besides that, there are other benefits to own your primarily residence.
Primary residence. Yeah. So it depends on your income and the cost of your property. So in general, the big things that you can take as tax deductions are mortgage interest and real estate taxes. However, they have increased the standard deduction. So the government gives you two things each year, either a standard deduction or an itemized deduction to reduce the income subject to tax each year. And if the things that are itemized add up to more than the standard, then you itemize. The things that are itemized are medical expenses, state taxes, real estate taxes, mortgage interest, and charitable contributions. Now, they have capped now state taxes and real estate taxes at $10,000, no matter how much you pay. So singles, it's a lot easier to benefit from homeownership than couples these days. So the standard deduction for 2020 is $12,400. So if you're single, you need at least $2,400 of mortgage interest and charitable contributions to be able to benefit from this. That's not too bad. A couple, it's $24,800. So you need $14,800, and next year it's like $25,700 of mortgage interest and charitables. That's a pretty big mortgage.
Yeah.
So for some people these days, under current tax laws, you're not going to get that every year tax benefit. So that's something to keep in mind, of like, just make sure that you can afford the payment based on what it is. And
So
when people
standard deduction, if they are not qualifying for the standard deduction, they can go.
If they don't qualify for the itemized, then they take the standard.
Got it.
So if your charitables, your mortgage interest, and your taxes add up to more than that 12.4 or 24.8, then you do that. But for a lot of people, myself included, I can't itemize anymore.
It's
like, I don't have that big of a mortgage and I'm very charitable, but like, that's a pretty big chunk. So a lot of people will give money away every other year and bunch them so that they can itemize. But just so when people, sometimes people are like, well, they told me I could afford more than I think. That's because that tax savings reduces your cash flow on your tax return. So in reality, you should be able to take less money out of your paycheck because your tax bill is going down, and that will help you pay the additional housing costs. Does that make sense? But right now, for some people, that's not the case. Like I said, if you're single, it's a lot easier because it's the same 10,000 whether you're single or married for that cap on the taxes. So if you are married, you just want to look at that. So you're not expecting a reduction in your taxes that you may not get. Now, given that we have a new administration, I don't know what's going to happen with the tax laws. I mean, they're double who knows? So all you can do is, and I tell people, and I don't know what your philosophy is, like your principal residence, buy it because it's where you want to live. Like, don't buy it for the tax savings or the appreciation. Buy it because it's where you want to live. And if you happen to get anything, that's a bonus. But make it affordable based on assuming nothing. Now, let's see what else.
In terms of appreciation, they still can take it and lower their taxable.
Well, that's the thing. You get that tax-free appreciation. That's huge. And like your costs aren't going to go up, like unless your assessment or real estate taxes, but like your house payment, your mortgage isn't going to. And for me, like I've refinanced. I mean, our mortgage is at a very low rate. I mean, it's kind of ridiculous right now. So, if you are at somewhere where like you want to stay for a while, it's great. If you're not sure, you really have to think about beyond that, because as you know, it's great to get in. That exit cost of paying the commission is where it's at, where the kicker is. So you have to think about the whole, and I even tell people, even with the rentals, is you can't just think about, oh, this year I'm not getting it. Over the life that you own that property, does it make sense? Do you know what I mean? You can't think about it this year. I mean, I had a rental property in blue collar Detroit that we sold after the whole market crash there, and we ended up having to bring money to the table as the sellers because the market was so bad. But if you looked at all the years we had it, we made so much cash. Like we definitely made money. It just, we got the cash and I had to give a little bit back at closing. So like if you just look at that, you're like, oh my God, that was terrible. It wasn't terrible.
Yeah, you kind of have to look at the whole picture and the business. You keep making income and take it.
I mean, for years it was a cash cow was awesome. And we talk about the suspended losses on the rentals. Well, like, hopefully you don't have a loss. Hopefully it's a property that's making money. I mean, that's not an issue. That's a good thing, right? Yeah. So, and then, let's see. Oh, the other thing on the mortgages, on the other end of the spectrum, if you are buying a very high-end house, you can only deduct mortgage interest up to $750,000 of outstanding principal for new loans. So we just take the percentage of it. So if it's, $1 million, I take 3/4 of whatever you paid. So just keep that in mind that even on those, they're not all deductible. It used to be $1 million prior to 2018. Now it's $750,000.
Got it.
So I do have some people that
kind of like they cannot
take. It's a problem,
Yeah, but it's a nice problem to have when you are there.
But it's good to know that, like, when you're thinking about, well, do I have other cash that maybe I want to put down so I'm not hitting that 750, 751, you know what I mean? Like, there's all things just to be aware so you can make a decision that works for your cash flow and what you're trying to get.
And it also changes, so you don't know where it's going to be again. And as you said,
well, so 1 year you might be over, and then you pay it down, and then you're fine. So on the form that they send you with your mortgage interest, it lists the outstanding principal. So I have to look at that.
Oh no, what I mean is like the amount changes. It's 750 or $1 million or.
Well, no, it was just when Trump passed his first tax bill, they lowered it to 750. So unless they change it, that's what the law is right now.
Got it. So it's not as flexible as other.
No, it doesn't. It's not like, a flexible mortgage that goes, it was $1 million forever, and then they changed that down.
Well, that's a good thing to know, because if people got used to have it at $1 million, you don't want to have a surprise. Just kind of know what
Well, but that's it. It just make an informed decision. Like you can still take $1 million mortgage, just make sure you understand what the true cost is after the tax savings. Exactly.
Awesome. Then also, Lisa, in the process of buying a home, owning it, I actually had quite a few questions in December and January, and I feel it's because of this time of the year where people can file homeowner exemption. What does it give to them? Should they file it? Tell us about it.
So the homeowner exemption is for your principal residence only, and you have to be the owner of record on January 1st of the year you're applying for. So you might not get it the first year you own your house, you know, because we do it in arrears. But then you can apply if you you go on the Cook County Treasurer's website, and the Cook County Treasurer's website is fantastic. It's actually pretty user friendly. I go there all the time. You can pay your taxes online, but you also can get your record of it. So if you need it for anything, or you need your PIN number, and you can look up by address your PIN number. I mean, it's a great site. So what it does is it reduces the assessed value that they assess the tax on by $10,000. So that times whatever the rate is what you save. So, I mean, it's a pretty good savings. And just so people realize, that's always taken off on the second payment each year. So the way the taxes in Cook County work is they take your prior year's tax, your first payment is 55% of that, and then they just true it up on the second one. So depending on if they raised or lowered it, often the second payment is lower because you get the exemption or whatever. If you did not claim it, and so if you go on there and you see your record, like if you go in and type in your PIN on that website, it will say, did you get that? If it says no, you can go back and claim it for prior years.
How many years back?
3 years you can go back.
Okay, because I actually went to Cook County website yesterday to just kind of double check, and they listed 2016, 17, 18, 19. I'm like, wow, this
So you might be able to. I think it's 3 years. I haven't done it for a while, but I have lots of people that go back because so, you know, good accountants should look at it and be like, hey, you're not taking this. You need to do this. You're leaving money. I do that with a lot of people.
Yeah, awesome. And pretty much if somebody goes ahead and files it for 16, 17, 18, 19, the Cook County is going to give them back whatever is
A lot of money.
Right?
Yeah. Now that gets subtracted from whatever you paid for your deductible taxes in that current year, but you're still coming out ahead.
Yeah. So is it gonna lower your taxes the following year, or?
So once it's in there and you're in there as the homeowner of record, unless there's a sale that's registered for that PIN number, it will keep going each year.
So if there is a sale that is registering after, I guess like if there is a sale, what happens?
Well, so then they don't do it because you weren't, you know, I mean, the new person has to apply. So when you purchase a property, you have to apply for the new property.
So when you sell your primarily residence, but you never took the homeowner exemption.
Oh, for a property you used to have? Is that what you're asking?
Well, I guess if you're, so I have actually two people right now in the same situation. They are selling the property. We are closing within the next like 3 to 4 weeks, and they never claimed the exemption.
So I think if you go in now, you should be okay because you're still the owner of record right now, but I would have them get on the ball right away. You know what I mean? You know, it's the government. They should go back and give it to you, but I haven't had anyone do that.
Got it. You know, well, I'll let you know how it works out because
let me know. But that's what you should have. See, there are values having an accountant because if you just did it yourself, you might miss that, and that could pay for my fee. Do you know what I mean? Like, I look at because even now, like Illinois, to get that real estate tax credit, you have to put the PIN number down, and if it doesn't match, they send you a notice. So I go on the site and make sure I check everybody's PIN number. Well, then I can look at it and check them, and that's really easy value add. That, you know, and there's also a senior exemption. Once you hit a certain age, you can get a senior exemption. So if you have family members or neighbors, make sure you're getting that as well because it helps lower that taxes down.
How old
it'll freeze their assessed value, so it can't go up, which is really nice.
Nice. Do they freeze it for a period of time, or?
I think it's, you know, once you're at a certain age, then it's frozen.
Nice. Yeah. So
I haven't hit that age yet, thank God. So I'm not.
What is the age limit for that?
I think it's 65, but I will check. I can let you know on that one.
Sounds good. Yes.
I don't have the number yet.
And it's definitely, it feels like if there is a small little mistake and person sells the property, and let's say they misprinted the PIN number on the homeowner exemption application, you can kind of lose some good money, which you wouldn't be able to get back because you're no longer.
And you need to be a smart taxpayer and homeowner. I mean, you cannot just rely on other people. You have to be an active participant. even if you're not an investor, you're just a homeowner. I mean, you need to be looking at your tax return. You need to be doing that. I tell my clients, I'm like, yes, I'm doing this, but you are ultimately responsible for this, right? So, and you want to make sure, the good thing about going on that site is I once had the bank that had the escrow for me had the wrong PIN number attached to my account. So it showed that mine wasn't paid, and they had me attached to some property that was like twice the value of mine. And then they're trying to take it. And I'm like, it was a nightmare. So now I just pay my own. I don't do it, but sometimes they don't let you, depending on if you're a first time home. So just like the first time that you, buy a new property, if you have escrow, when your bank pays that for you, go on that site and check it to make sure that the right amount was paid. Because we couldn't refinance till it got taken care of. It took probably months to get it. I mean, it was not fun. So I just tell people, be an active taxpayer, because people make mistakes.
Yep. And as we say, for many people in this country, your house is your biggest investment.
Oh, yeah.
Pay some attention to that.
Right. For most people, it is.
Yeah. And it's not that difficult. You just need to know a few little things and kind of keep watching them. So.
Well, here's the thing, and I say this all the time. We're not taught this stuff. So unless someone says to you, hey, you should go do this, it doesn't even occur to you to do it.
Yeah, thank you for bringing all these subjects up, because I'm sure there are a lot of people out there who never even thought to check if the bank paid their taxes.
Right. I mean, once you have it in there once, you're probably fine with it, but I don't want anyone to go through what I went through.
There are mistakes everywhere. It's all humans anyways, and it's better to...
They're just people. And so, that was a while ago. Maybe it's done more automatically, but, it is the government. So you gotta check it.
Just make sure you got it there. Yep. All right. Well, Lisa, it is January 2021, so beginning of the year, right? Where did the time go? It felt like 2020 was long, but very fast at the same time. Anyways, we are at the beginning of a new year. Many people start their tax books for this year. Any tips or suggestions? What shall we be looking at, paying attention to, so that we are well together at the end of this?
Well, there are a couple of things that are kind of unique for this year. So the biggest one is those stimulus checks. Yeah. So if you got a stimulus check, it's not taxable to you. That's the first thing. If your situation changed, so they based on your 2018 or 2019 taxes, but let's say you lost your job and you're eligible for a larger payment based on your 2020 income, you can claim the difference or get it in total on your 2020 tax return. So if that's the case, you want to get that return filed, sooner rather than later, because you'll get that money. So that's really important. If you aren't eligible at all, or you didn't get any, it's fine. But if you got either one, you need to be able to report on your tax return the exact amount you got for each of those payments. And even though you're getting the second payment in 2021, it counts for 2020. So just people should be aware of that. There was a form, I think it's called 1444. There was a letter from the IRS that came out like 2 weeks after you got your first payment. And there's a new one called 1444E that should be coming out. Nobody kept it. I wasn't even aware of it till later. But keep your eyes open for it and keep it with your tax records, because it'll make apparently, I don't know that there's a lookup. There should be a lookup system, but that's still up for grabs. I don't know if there is. So if you're not sure, go back to your bank and look for it. Do you know what I mean? Because you're going to need.
So the bank will give them that form.
Well,
right?
you can go to your bank and look for the IRS deposit. Do you know what I mean? Back in.
Yeah. Well, I'm sure most people probably would remember what was it.
Yeah, but if you don't know the exact amount, you're like, okay, whatever. The other one that's really important is if you got unemployment, that's taxable income in the federal and the state. Mm-hmm. And even if you ask for withholding, the max they take out of that on the federal side is 10%. So depending on where you are with your other income, just be aware that there may be additional taxes due on that. So it may reduce any expected refund, or you may actually owe on that. So, and there's a form, it's called 1099G, that you will be getting in the mail. So keep your eye open for that if you got unemployment. So make sure you report that on there. One thing that's really nice that they added for 2020, and they just extended for 2021, is if you can't itemize, because those itemized deduction, the standard deduction limits are so high, they have added, so anyone that doesn't itemize can claim up to $300 of cash charitable contributions on their return, even if they don't itemize. It's only cash though, it's not like clothing and other things. So my clients, I'm asking for receipts. It's not like, oh, you can just put 300. I'm like, no. You actually have to be charitable. Like, no. Now that is per return. So whether you're single or married, $300. For 2021, they fixed that. So it's $300 for a single return, $600 for a married return. But for 2020, it's not. There's lots of weird things in there. Here's one that's good. If you claimed a home, so home office is something that I get a lot of questions about. If you are a W-2 employee, that option for a home office was eliminated. So you are not eligible for that.
Interesting, but a lot of W-2 employees are working from home today.
Yeah.
Interesting. Okay.
Now here's the thing, and I tell people, but you're not paying for dry cleaning, you're not paying for commuting. I mean, it offsets. Do you know what I mean? It is what it is. A lot of people, though, to be honest, didn't get that deduction anyway, because it was in a section called miscellaneous itemized deductions subject to a 2% floor. So all those unreimbursed things, including home office, had to exceed 2% of your income to even qualify, and you had to be able to itemize. So almost nobody got it. So, people are like, oh, I'm like, you didn't get it anyway. Now, if you are self-employed, a lot of people are taking a home office anyway, and there's very specific rules on that. But one thing that I always tell people is I actually called the IRS back when they started doing this home office. And I'm like, okay, so how do you audit this? What are you looking for? Because there's 2 rules for it. You have to use it regularly, which everybody qualifies for, and exclusively, which is the big one. So it can't be like, your guest room, you're sharing, your gym, and like it's got to be a space that's just used for business. So what they recommended is if you claim that home office, take a photo of the space every year. So like you can see mine's my office. Okay, just take a photo of this and throw it in with your tax records. Because that way, if they come auditing you, it's 2-3 years down the road. 1, you might not even be living there. Or 2, it might be, now your office is your nursery. So like if you're really doing it, it's not that hard. Just take the picture and throw it in every year.
Interesting. So you submit the picture with your tax return?
No, you don't submit it. It's it's kind of like all your business receipts. Keep it in case they ask. Now, I've never had anyone audited whose return I prepared, but I have represented people at an audit. And the gentleman that I represented had, a Schedule C business. He had 2 rental properties and a home office. They wanted every receipt, not the credit card statement, every receipt total for each, expense category. They want to see the floor plan of their house so they could see the square footage percentage. They asked for it all. Now, if you don't get audited, doesn't matter, but
be safe. Yeah.
Here's the thing. If you are self-employed or you have a rental property or home office, your odds of being audited have increased, because if you just have a W-2, or there's no way to cheat. Like, what do you do? The numbers match, right? So if you have your own business, or you have you can add personal expenses in there that aren't, right? So like maybe you're taking some of your home expenses, which are personal, and you're making it into a home office. Those are things that are more likely to be questioned. So if it's legit, just keep your receipts and run it right? It's not that hard.
Right.
So, and then the last one is make sure you file everything on time and stay on top of these tax deadlines, because people are not aware of this, but the penalty for late filing is 10 times the penalty for late paying.
Oh.
So even if you can't pay, send it in. File. Because taxes are bad enough. You don't have to pay penalties, right? And people are totally not aware of it. Now, I send my clients reminders of estimated tax deadlines, all this stuff. Apparently not all accountants do that, I learned. So, that's just keep it in mind. It comes now, as of today, we're in January. They have not said they're extending the tax deadline. It's still going to be April 15th. So, it's going to be fun.
As always, I'm glad you're laughing at this, because you're the one.
I can't complain. I love what I do. I'm very grateful. So I just wish it were more spread out.
Right? Yeah, it feels like in your profession, it's not fair. You guys are busy around April and around what, September, October. That's crazy.
Well, that's why I've got some new things going on. For me, it's like I said, I like the teaching side of it. So I do the tax returns to build the trust up with someone, and then I can teach them, because I even have people where I'm like, hey, do you know what all these numbers on your W-2 mean? People have no clue. Like, they've never even looked at it. And so I do that. I just added my first class. So for new entrepreneurs, there's a class, what new entrepreneurs need to know about taxes. So if you started a business, or even if you're like married and you have like a side business and you just need to understand what's deductible or not, it's an on-demand class, takingontaxestogether.com, that you can pause or rewatch. And it's just really, I'm breaking it down, trying to make it as fun as possible. So it's not to make you a tax expert. It's like I said, so you can ask good questions, so you can not pay more taxes than you need to. You understand how to keep records. It's just stuff you need to know that you're not taught about, right? It's crazy. And then the rest of the year, I like to do talks for people or help, I've talked at real estate offices. I'm looking hopefully to talk at like companies, like they do wellness benefits. Wouldn't it be great to do like financial wellness benefits? Like,
wouldn't it?
About it, right?
A lot of people actually, my observation, when people are W-9 or W-2, I'm sorry.
W-2. Mm-hmm.
So everything is taken care of them in the company. They don't even think in the Department of Taxes too much.
But they should.
And personally, when I had my W-2 years ago, I did a TurboTax and I was like, yeah, that's fine. And when I got my first investment property, I'm like, oh, I don't think it's fine anymore. And that's when you start thinking, when you go away, start making W-9 income. And I feel for W-2 people, there is so much opportunities out there and they are not aware of it. And they come to us with questions because they've got the income, they've got everything together, but they don't know how to place it in
right. Well, and even if you're a W-2 employee, you get to a point where like you have investments. What kind of investment should you have? Should you do a Roth rollover? Should I be saving in a 529 account? Like, there's just a lot out there that I tell people, look, TurboTax, I don't have a problem with TurboTax. I don't know how to use it. So don't call me and ask me how to use it, because my system is completely different. But TurboTax gets you a tax return. The tax return is the least important part of what I do. Mine is I'm available to answer questions. I help you make informed decisions. My philosophy is I can crunch numbers for you, but that's not the only reason you make a decision. Does it fit with you, and does it work for what you want? Yep. And you need information to get that, and I can easily get it for you. I mean, I did a thing for people when the pandemic hit, and I was like, oh my God, my income's changing, whatever. Yes, but if you do a budget of what you had before and you have a budget now, and even if you're so my husband's bonus went down by 1/3. Well, by the time you take out the tax difference and then you take out all the commute, it really wasn't that bad. I mean, yes, we made less money, but we weren't panicking because that tax number goes down so much that having someone help you put that correct number in your budget, people don't put the correct Social Security, Medicare taxes in there. And that's probably one of your biggest expenses other than your housing costs. Right. Insurance, housing, and taxes are it. And people, if you don't have accurate numbers, you can't make good decisions. So I'm like, I think everyone should have an accountant, but I don't have a problem. As long as you are involved in it, that's what I think is important. We interact with taxes every single day. It is worth your time to understand. Now, if you want to learn more, I'm on LinkedIn. I write fun little posts every day. Please reach out to me, because I've been having a good time and I've been teaching people. So yeah, I like it. I mean, people laugh, but I'm like, I love taxes.
Awesome. All right. And Lisa, if you don't mind, I'm going to put your contact information and maybe a link to your class so people can research more.
Okay. Wonderful.
Awesome.
Yeah, and I have another class for real estate investors too that I can share with you once I get that put on the site.
Awesome. It feels like we might do another call and talk about investment side only.
Yeah, definitely. I've done lots of talks on that, and it's really important. And it's a really good thing for realtors to understand too, so you can differentiate yourself from other realtors, that you can help your clients understand, or at least go get the information that they need to understand what's going on. You're not just trying to sell them the property. It's like, no, this is how the cash flow works.
Yeah. Awesome.
Yeah, people are really appreciative of that, because you're not taught it either. You're taught how to sell a house and buy it, like that's what you're good at. So
yeah, but
really need
the numbers together give the rounded picture. It's a whole different story.
Yeah.
Awesome. All right. Well, thank you so much, Lisa.
Oh, it's wonderful.
Next one, and have an awesome weekend.
Thank you. You too.
Thank you. Bye-bye.